The global financial system operates on a foundation of trust, a collective agreement that the numbers on a screen represent tangible value. But underneath the glass towers of Manhattan and the marble halls of Washington, D.C., a structural erosion is taking place. This is not the sudden explosion of a market crash, but a slow-motion unraveling of the fiscal architecture that has supported American prosperity since the end of the Second World War. Today, the United States faces a national debt exceeding $34 trillion, a figure so vast it defies human intuition. As interest rates remain elevated to combat persistent inflation, the cost of servicing this debt is beginning to eclipse the nation's total defense budget. We are entering an era of reckoning where the tools once used to rescue the economy are becoming the very sources of its instability. The cracks are no longer invisible. They are appearing in the bond markets, the banking sector, and the purchasing power of the average citizen. This is a study of systemic fragility and the end of the era of easy choices. The first tremors of fiscal instability rarely appear in the headlines. Instead, they manifest in the quiet data points of the bond market and the rising delinquency rates of the American consumer. For over a year, the yield curve, the difference between short-term and long-term interest rates, has remained deeply inverted. Historically, this phenomenon is a reliable harbinger of recession, signaling that investors have lost confidence in the immediate economic future. Simultaneously, the commercial real estate sector is facing a wall of maturities. Hundreds of billions of dollars in loans, originated in a low-interest environment, are GIO coming due at rates that double or triple the previous cost of capital. In the residential market, despite a shortage of supply, the dream of homeownership has become a mathematical impossibility for the middle class as mortgage rates hit 20-year highs. These are not isolated incidents. They are the warning signs of a system that has lost its elasticity, struggling to adapt to the reality of expensive money. To understand the architecture of decay, one must first grasp the mechanics of debt and the gravity of interest rates. In the simplest terms, interest is the price of time and the cost of risk. For decades, the global economy flourished under a regime of near-zero interest rates, which encouraged a massive accumulation of leverage across all sectors. However, when the Federal Reserve raises the federal funds rate to combat inflation, it fundamentally alters the math of the entire financial system. The United States government, as the world's largest borrower, is particularly sensitive to these shifts. As older bonds, issued at 1 or 2%, mature, they must be refinanced at 5% or higher. This transition is not merely a technical adjustment, it is a profound fiscal shock. Currently, the interest payments on the national debt are accelerating toward the $1 trillion annual mark. This creates a dangerous feedback loop where the Treasury must issue new debt simply to pay the interest on existing obligations, a phenomenon that challenges the very definition of fiscal sustainability and limits the government's ability to respond to future crises. The tension within the debt market radiates directly into the banking system, where liquidity acts as the lifeblood of commerce. Banks operate on the spread between the interest they pay to depositors and the interest they earn from loans and securities. When interest rates rise abruptly, the value of existing long-term bonds held on bank balance sheets falls. This was the catalyst for the regional banking crisis of 2023, where unrealized losses created a crisis of confidence. But the deeper issue is liquidity, the ease with which assets can be converted to cash without losing value. In a high-rate environment, liquidity tends to evaporate as investors flee to the safety of short-term government paper. This leaves the shadow banking sector, non-bank financial intermediaries that provide a huge portion of global credit, vulnerable to sudden stops. If these institutions cannot roll over their funding, the resulting credit crunch can paralyze small businesses and consumers alike, transforming a financial friction into a broad economic standstill. At the center of this structural decay lies the United States Treasury bond, often called the risk-free rate of the world. Global finance is built on the assumption that U.S. debt is the safest possible asset. However, as the supply of these bonds increases to fund massive deficits, the market's ability to absorb them is being tested. The U.S. dollar index, DXY, remains a dominant force, but its strength is a double-edged sword. A strong dollar makes U.S. debt attractive, yet it simultaneously crushes emerging markets that have borrowed in dollars, leading to potential defaults abroad. We are seeing a shift in the global demand for treasuries as foreign central banks diversify their reserves away from the dollar in response to geopolitical tensions and fiscal concerns. If the primary dealers, the large banks required to buy government debt, reach their capacity, the Federal Reserve may be forced to intervene as the buyer of last resort. This process, known as debt monetization, risks fueling further inflation and undermining the very currency the system is designed to protect. Systemic risk is often hidden in plain sight, masked by the complexity of modern financial instruments. One of the most sensitive indicators of this fragility is the credit default swap, CDS spread, essentially an insurance premium against a borrower's default. In recent years, the CDS spreads for U.S. sovereign debt have seen unusual spikes, reflecting a growing, albeit small, fear that political gridlock or fiscal exhaustion could lead to a technical default. While a full-scale default remains unlikely, even the perception of risk can be catastrophic. It increases the cost of borrowing for everyone, from the federal government to a family buying a car. This fragility is exacerbated by the sheer scale of the derivatives market, which is many times larger than the global GDP. When volatility increases, these complex contracts can trigger margin calls and forced liquidations, creating a domino effect that moves faster than regulators can react. We are operating a high-speed financial engine on an aging infrastructure of debt, where a single mechanical failure in the plumbing of the repo market can threaten the entire global edifice. To understand where we are going, we must look at where we have been. The Great Depression of 1929 provides a haunting blueprint of what happens when a debt-fueled boom meets a liquidity collapse. In the 1920s, much like today, credit was easy and asset prices reached dizzying heights. When the bubble burst, the lack of a robust central bank response led to a catastrophic deflationary spiral. Today, the risk is different. We face the threat of stagflation, a combination of stagnant growth and high inflation that plagued the 1970s. However, the scale of debt today makes the 1920s look modest. In 1929, the U.S. national debt was roughly $16 billion. Today, it is thousands of times higher. The lesson from history is that systems of credit are fragile and rely entirely on the expectation of future growth. When that growth fails to materialize, the debt becomes a weight that drags the entire economy into the abyss. Unlike the 1930s, the world is now hyper-connected, meaning a fiscal failure in one major economy can trigger an instantaneous global contagion. The 2008 global financial crisis serves as a more recent reminder of systemic failure. That crisis was driven by private sector debt, specifically subprime mortgages, and the failure of major investment banks like Lehman Brothers. The government and the Federal Reserve responded by flooding the system with liquidity through quantitative easing, effectively moving the bad debt from private balance sheets to the public ledger. For 15 years, this strategy appeared to work, suppressing volatility and supporting asset prices. But it also created a moral hazard where markets began to expect a Fed put, a guarantee that the central bank would always intervene to stop a decline. Now we are facing the aftermath of that intervention. The reckoning in our title refers to the fact that the debt has not disappeared. It has merely been consolidated at the sovereign level. In 2008, the government had the fiscal space to bail out the banks. Today, with debt to GDP ratios at record highs, the question is, who will be there to bail out the government? The American case is unique because of the U.S. dollar's status as the global reserve currency. This exorbitant privilege has allowed the U.S. to run massive deficits for decades without facing the immediate consequences that would ruin a smaller nation. But the architecture is decaying. The national debt is no longer a partisan talking point. It is a mathematical reality that constrains every move the Federal Reserve makes. If the Fed keeps interest rates high to fight inflation, it risks a fiscal crisis as the government's interest costs explode. If it cuts rates to save the Treasury, it risks letting inflation run rampant, which destroys the purchasing power of the dollar. This is the impossible trinity of modern central banking. We are seeing the Fed trapped between its mandate for price stability and the structural necessity of keeping the government solvent. The Fed's balance sheet, which expanded to nearly $9 trillion, is now being slowly reduced through quantitative tightening, removing the very liquidity that markets have grown addicted to over the past decade. This fiscal pressure is reflected in asset markets, which have become increasingly decoupled from economic reality. For years, the everything bubble pushed stocks, real estate, and even speculative cryptocurrencies to record valuations, driven by the search for yield in a world of 0% interest. Now, as the cost of capital rises, we are seeing a painful repricing. The S&P 500 and the Nasdaq are no longer just reflections of corporate earnings, they are reflections of liquidity conditions. Real estate markets in particular are at a dangerous juncture. The lock-in effect, where homeowners refuse to sell because they have low-rate mortgages, has frozen supply, keeping prices artificially high even as demand craters. This creates a stagnant market that is vulnerable to a sharp correction if unemployment begins to rise. When the middle class sees their primary store of wealth, their home, decline in value at the same time their cost of living increases, the social contract begins to fray. The architecture of decay is not just about numbers. It is about the erosion of the American dream. While the U.S. struggles with structural decay, other nations offer a glimpse into the terminal stages of fiscal collapse. Argentina and Turkey serve as modern case studies in the destruction of a currency through mismanagement and hyperinflation. In Argentina, decades of deficit spending and a reliance on foreign debt led to a cycle of defaults and IMF bailouts. The result is a country where inflation has exceeded 100%, and the local currency has lost almost all its value as a medium of exchange. In Turkey, an unconventional monetary policy of lowering rates in the face of rising inflation led to a collapse of the lira. These examples demonstrate that once trust in a currency is lost, it is nearly impossible to regain without massive societal pain. These nations are the canaries in the coal mine, showing that even relatively large industrialized economies are not immune to the laws of mathematics. When a government can no longer borrow in its own currency at reasonable rates, it must resort to the printing press, which is the final stage of fiscal decay. The Eurozone crisis of the early 2010s, specifically the case of Greece, provides a different lesson: the danger of a shared currency without a shared fiscal authority. Greece found itself unable to devalue its currency to remain competitive and unable to print euros to pay its debts. The resulting austerity measures led to a lost decade of economic growth, with youth unemployment reaching 50%. Today, the risks in Europe have shifted to larger economies like Italy, which carries a debt burden that could threaten the stability of the entire European Union. The European Central Bank is forced to engage in fragmentation tools to prevent the bond yields of weaker nations from diverging too far from Germany's. This illustrates the fragility of the global bond market. The system is only as strong as its weakest link. As global liquidity tightens, the pressure on these indebted nations increases, creating a risk of sovereign defaults that could trigger a banking crisis across the Atlantic and beyond. We must also look back to the 1997 Asian financial crisis to understand the importance of foreign exchange reserves and the contagion effect. What began as a currency devaluation in Thailand quickly spread to Indonesia, South Korea, and Malaysia as investors panicked and pulled their capital out of the entire region. The IMF intervened with harsh conditions, leading to widespread social unrest. This crisis taught emerging markets a vital lesson. They must accumulate massive piles of US dollars to protect themselves from sudden capital outflows. This created the global savings glut that ironically allowed the US to borrow even more cheaply for the next 2 decades. But today, the roles are reversing. As the US dollar strengthens and the Fed tightens, the dollar shortage is returning to the developing world. Nations that are short on reserves are finding it impossible to pay for essential imports like food and energy, leading to the type of systemic instability we saw in Sri Lanka. The global fiscal architecture is a web, and a tear in one corner can quickly unspool the entire structure. The spillover effect into Europe and Asia is already visible. As the U.S. exports its inflation through a stronger dollar, other central banks are forced to raise rates even if their local economies are weak, just to prevent their currencies from collapsing. This is monetary policy imperialism. In Japan, the world's third-largest economy, the situation is even more precarious. The Bank of Japan has spent years attempting to generate inflation through yield curve control, but now they are trapped. If they let rates rise, the cost of servicing Japan's massive debt, over 250% of GDP, becomes unsustainable. If they keep rates low, the yen collapses, making energy and food imports prohibitively expensive. This tension is a microcosm of the global problem. There are no good options left, only choices between different types of economic pain. The stability of the global financial system depends on a delicate balance between these major powers. But as domestic fiscal pressures mount, that cooperation is being replaced by economic nationalism and trade barriers. Geopolitics is now inseparable from financial stability. The rise of the BRICS nations and the increasing talk of de-dollarization represent a direct challenge to the American-led fiscal architecture. For the first time in 80 years, major global players are actively looking for alternatives to the dollar for international trade and oil settlements. While the dollar remains dominant for now, the trend is clear. The world is moving toward a multipolar financial system. This shift has profound implications for U.S. bond markets. If foreign nations stop recycling their trade surpluses into U.S. treasuries, the U.S. will have to pay much higher interest rates to attract domestic buyers. This would accelerate the domestic fiscal reckoning we have been discussing. Furthermore, the use of financial sanctions as a tool of foreign policy, such as freezing Russia's central bank reserves, has sent a signal to every other nation that their dollar assets are only safe as long as they remain in Washington's good graces. This weaponization of finance is a catalyst for the decay of the existing global order. For the ordinary worker, the architecture of decay is felt not in the bond market, but at the grocery store and in the monthly paycheck. Inflation is often called a regressive tax because it hits the poorest families the hardest as they spend a larger percentage of their income on essentials. While nominal wages have risen, real wages, wages adjusted for inflation, have struggled to keep pace for many sectors. This leads to a phenomenon known as cost of living stress, where families are forced to dip into savings or use credit cards to maintain their standard of living. Employment remains a bright spot in the data, but the quality of that employment is shifting. We see a rise in part-time gig work and multiple job holding, which masks a deeper fragility in the labor market. If the economy enters a hard landing recession as a result of the Fed's tightening, the surge in unemployment could lead to a wave of consumer defaults that the banking system is ill-prepared to handle. The middle class is being squeezed between rising costs and the threat of job loss. Small businesses, the traditional engine of the U.S. economy, are particularly vulnerable in this environment. Unlike large corporations, which can issue long-term bonds at fixed rates, small businesses rely heavily on floating-rate bank loans and lines of credit. As interest rates rise, their debt service costs increase immediately, eating into thin margins. Furthermore, as the cost of doing business rises due to higher energy, labor, and material costs, many small firms are finding they can no longer pass these costs on to a stretched consumer. We are seeing a quiet crisis in the Main Street economy, characterized by a slowdown in new business formation and an increase in bankruptcies. The loss of these businesses doesn't just impact GDP, it destroys the social fabric of communities and reduces the competitive pressure that keeps prices low. The architecture of decay is hollowing out the middle of the economy, leaving behind a landscape dominated by a few massive, cash-rich corporations and a struggling class of entrepreneurs. The government's response to these challenges has been hampered by extreme political polarization. Fiscal policy, the use of government spending and taxation to influence the economy, is currently moving in the opposite direction of monetary policy. While the Federal Reserve is trying to cool the economy by raising rates, the government continues to run massive deficits, which adds fuel to the inflationary fire. There is no political appetite for austerity, cutting spending or raising taxes, especially in an election cycle. This means the burden of fixing the economy falls entirely on the Federal Reserve, which only has one tool: interest rates. This mismatch between fiscal and monetary policy is a hallmark of an aging empire in decline. When a nation can no longer agree on how to balance its books, it defaults to the path of least resistance: more debt and more currency debasement. The reckoning is delayed by short-term fixes, but each fix makes the ultimate adjustment more painful. The Federal Reserve's current path is one of higher for longer. They are attempting a soft landing, bringing inflation down to 2% without triggering a severe recession. But this is a historically difficult feat. The central bank must navigate a narrow path where they do enough to kill inflation, but not so much that they break the financial system. Their actions are also constrained by the shadow of the debt. Every rate hike increases the federal deficit by billions of dollars, creating a situation where the Fed is effectively fighting itself. We are also seeing a shift in the Fed's communication as they try to manage market expectations and prevent a melt-up in stock prices that would counteract their tightening efforts. The reality is that central banks are no longer the all-powerful deities they were once perceived to be. They are reactive, not proactive, and they are struggling to control a globalized system that has become too large and too complex for any single institution to manage. The tension between short-term fixes and long-term risks is reaching a breaking point. Short-term fixes like government subsidies for energy or temporary pauses on student loan payments provide immediate relief but do nothing to address the underlying structural issues. In fact, they often make the long-term problem worse by encouraging more consumption and more debt. The long-term risk is fiscal dominance, a state where the central bank is forced to abandon its inflation targets to ensure the government can afford its debt payments. This is the ultimate endpoint of the architecture of decay. Once a nation enters fiscal dominance, the currency begins a permanent decline, and the economy enters a period of long-term stagnation. To avoid this, the U.S. would need a decade of fiscal discipline, structural reform of entitlement programs, and a focus on real productivity growth rather than financial engineering. Currently, there is little evidence that such a path is being seriously considered by those in power. If we look for the most fragile points in the system today, we find them in the plumbing of the financial markets. The repo market, where banks and hedge funds exchange high-quality collateral for overnight cash, is the foundation of global liquidity. In 2019, this market broke, requiring a massive intervention from the Fed. Today, the risks have migrated to the hedge fund world, where basis trades, complex bets on the difference between cash bonds and futures, have reached trillion-dollar levels. These trades are highly leveraged, meaning a small move in the market can trigger a massive liquidation. This is the hidden debt that regulators struggle to track. If a major fund fails, it could trigger a fire sale of U.S. Treasuries, sending interest rates skyrocketing and freezing the credit markets. This is the systemic risk that keeps central bankers awake at night. A technical failure in the market infrastructure that translates into a real-world catastrophe in a matter of hours. In a worst-case scenario, the architecture of decay leads to a global debt jubilee or a chaotic systemic reset. This would involve a wave of sovereign defaults, the collapse of major currencies, and a total breakdown of international trade. In this scenario, the U.S. dollar loses its reserve status rapidly, leading to hyperinflation in the United States as trillions of dollars held abroad rush back to the domestic economy. Wealth held in traditional financial assets, stocks, bonds, and bank deposits, is decimated. This leads to widespread social unrest and a total reorganization of the political order. While this sounds like the plot of a dystopian novel, it is the historical norm for empires that overextend themselves financially. When the debt can no longer be paid in currency of value, it is paid through the destruction of that currency. This is the great reset that many fear, where the old rules of finance are swept away by the sheer force of mathematical necessity. A more likely base case scenario is the long squeeze, a decade of low growth, persistent inflation, and declining living standards. This is the Japanification of the West, but with the added complication of high inflation. In this scenario, the government manages to avoid a total collapse by using financial repression, keeping interest rates below the rate of inflation. This effectively transfers wealth from savers and bondholders to the government by devaluing the debt in real terms. The stock market may remain flat in real terms, while the cost of essentials continues to rise. The middle class continues to shrink, and social mobility becomes a thing of the past. It is a slow, grinding decline rather than a sudden explosion. It is an economy of making do, where the excesses of the past are replaced by a new reality of scarcity and caution. This is the new normal that many economists believe we have already entered. The best-case scenario relies on a productivity miracle. This would involve a sudden surge in economic output driven by technological breakthroughs, such as artificial intelligence, fusion energy, or a revolution in biotechnology. If the economy can grow faster than the debt, perhaps at 4 or 5% per year, the debt-to-GDP ratio would naturally decline over time, allowing the U.S. to grow its way out of the crisis. This occurred after World War II, when a combination of a manufacturing boom and a younger workforce allowed the U.S. to pay down its massive war debts. However, this requires more than just technology. It requires a stable political environment and a workforce capable of adapting to these changes. It also requires the government to stop adding to the debt so that the new growth can be used to repair the balance sheet. While this is the most optimistic path, it is also the one that requires the most things to go right at once. For the individual, survival in the architecture of decay requires a shift in mindset. The old advice of buy and hold a diversified portfolio of stocks and bonds may no longer be sufficient in a world of high inflation and systemic risk. Practical strategies include reducing high-interest consumer debt, building a resiliency fund of liquid cash and physical assets like gold or silver, and investing in real skills that have value regardless of the state of the financial system. Diversification must move beyond the financial markets into tangible assets, land, tools, and education. It also means becoming more skeptical of the guarantees provided by the state and the financial industry. In an era of reckoning, the most valuable asset is not a number in a bank account, but the ability to adapt to a changing environment. Self-reliance and community cooperation will become more important than financial leverage and speculation. The lessons from economic history are clear. No nation can borrow its way to permanent prosperity. From the Roman Empire's debasement of its silver coins to the collapse of the French assignats, the pattern is always the same. Prosperity is built on productivity, innovation, and trust. Debt is merely a way of pulling future consumption into the present. Eventually, the future arrives, and the debt must be reconciled. We have lived through a unique period of history where debt was viewed as a tool without consequences. That period is over. The architecture of decay is the physical manifestation of our refusal to make difficult choices over the last 30 years. Whether we face a sudden crash or a long decline, the outcome is a return to economic fundamentals. Those who understand these lessons will be better prepared for the transition. Those who ignore them will be its victims. We are standing at the edge of a fiscal reckoning that has been decades in the making. The signs are everywhere. In the rising cost of debt, the fragility of our banks, the volatility of our markets, and the anxiety of our citizens. The architecture of decay is not a prophecy of doom, but a call to realism. It is an acknowledgement that the systems we have relied upon are reaching their structural limits. The coming years will be defined by a search for stability in an unstable world. We will see the rise of new financial systems, the reconfiguration of global power, and a painful but necessary adjustment in our expectations of what the government can and should do. The era of something for nothing is ending, and the era of accountability is beginning. The choices we make now, as individuals and as a society, will determine whether we manage a graceful transition or a chaotic collapse. In the end, the economy is not just an abstract system of equations and charts. It is the sum total of human trust and labor. The architecture of decay is a reflection of a breakdown in that trust, a sense that the system is no longer working for the many, but only for the few who can navigate its complexities. As we move into this uncertain future, we must remember that the greatest crises in history have also been the catalysts for the greatest renewals. The reckoning we face is an opportunity to rebuild our fiscal house on a more solid foundation of honesty, productivity, and shared sacrifice. The road ahead will be difficult, and the challenges are immense, but the human capacity for adaptation remains our most powerful resource. The architecture of decay is crumbling, but what we build in its place is still within our control. The reckoning is here. The question is, are we ready?